Hello Scholar, today we are going to talk about chapter number 5, merchandising operations. If you remember from chapter number 1, we talked about 3 kinds of businesses. One was retailer, merchandisers, and wholesalers. These are the same thing, or we have what we call manufacturers. So wholesalers and merchandisers has one kind of inventory. Retailer also has one kind of inventory, but manufacturer has 3 kinds of inventory, and the one kind of inventory they have we call finished goods. Retailer also has finished goods, but the manufacturer has kind of inventory. One is called raw material, the third is called work in process inventory, and the third one is called finished goods. So you don't have to worry about raw material, work in process, and finished good inventory, because we are going to talk about these inventory in accounting next year, which means the second course of the accounting, which is accounting 2302. In this course we are mostly concerned with one kind of inventory, which is finished good, either sold by wholesalers or merchandisers. The merchandisers that we are talking about, they are work as a wholesale as well as retail as well. So a merchandiser is a business that sells merchandise or goods to customers, okay, but they do not manufacture. And this type of business sells is called merchandise inventory. So merchandise inventory or merchandiser, if you want to, let me give you an example for that. Let's say example, Best Buy. Best Buy sells home appliances. They sell fridge, washer and dryer, cooking range, microwave oven. And besides that, they have TV, they have computers, they have sound system, they have all kinds of computers, cell phones, but these are products from various manufacturers. So they have products from Frigidaire, for example, home appliances. They have kitchen appliances like, for example, Brahms. They have computers from, say, Dell and Apple. They have cell phones from Apple and Motorola. So all of those things that Best Buy is selling, they are selling to retailers, to what we call it, to the customer, but they haven't made or manufactured these products. So a wholesaler buys the goods from a manufacturer and sells them to retailers. In the past, and it's the case, that there is a wholesaler in the business that buys directly from the manufacturer in bulk, and then sells the goods to the retailers. But the thing is that system or that paradigm has been shifted more now, and we see that big retailers, big box stores such as Best Buy, Walmart, Target, and Amazon online, you can buy these things over there. So what they do, for example, Best Buy has thousands of stores throughout the United States, Canada, and Canada. So what they do, they directly buy things, say, from Apple or Motorola or Dell, and they get a big discounts, and then they sell these things cheaply to the customer and user. So a retail buys merchandise from manufacturers, or a wholesaler and then sells goods to consumers. So we do not really have a wholesaler much in a way we used to have 20 years or 30 years ago. However, we still talk about, because in certain areas there still wholesaler exist. Then we're going to talk about operating cycle of a merchandising business. So in a merchandising business like Best Buy, what is their operating cycle? It begins when the company purchases inventory from an individual or business called a vendor. So if we look for a merchandiser here, so basically Best Buy purchasing from Apple, all right, or Dell or anybody. So in that case, Apple is the vendor and the Best Buy is the merchandiser. The company then sells inventory to customer. So for example, you and I go to Best Buy and buy things. Finally, the company collects cash from customers. So what usually happens when we buy things from, say, Best Buy? Either you pay cash or you charge your credit card. So when you pay cash, for example, a check or money order, or write out just dollar bills, the merchandiser, which is Best Buy, receive the cash and hand it over you the inventory, and the transaction is done. When you charge a credit card, it takes about 2 to 3 days for Best Buy to recover the cash from the credit card company. So for example, you purchase something for $100. So the Best Buy will receive about $97 or $98 from the credit card company within 2 to 3 days, and after deducting $2 to $3, whatever their percentage they charge to Best Buy. So therefore, cash, checks, money order, and credit card all consider cash transactions. Okay. The income statement of the merchandise reports, there is a distinction. So when you have a merchandiser, and the cost is called, so the service sales revenue rather than service revenue. So merchandiser always have a sales revenue, though not a service, because service revenue is for those companies that provide service, such as doctor's office, dentist office, law office, accounting office. These are architectural, so they are providing you a service, so they call service revenue. Since merchandiser providing you tangible inventory made by somebody else, so they will call it sales revenue. The cost of merchandise sold to customer called cost of goods sold. So for example, they are selling you a computer, a laptop that they purchased for $450, and they are selling you for, say, $600. So the sales revenue is $600, the cost of goods sold is $450, and the gross profit is $150 on this particular computer. So gross profit is the sales revenue minus the cost of goods sold. Operating expenses, which are expenses other than cost of goods sold. So cost of goods sold is the cost that we have to pay to bring the computer from Apple all the way to the store and then put it on the shelf from where the customer can purchase. So that's the cost of goods sold included in this. Operating expenses, for example, is store rent or mortgage, stores utilities, is stores employee salary and or what we call it a bonus or commission. So these will be considered operating expenses for the store. Okay. So in this picture, we can see that we receive cash because of purchase merchandise for resale and places in inventory. Then, so we purchase, now we have an inventory in the back store, and then remove merchandise from inventory and deliver to customer once the customer is purchased. And if the customer is not paying you cash right away, they are giving you a promise. So that's account receivable we talked about earlier in the chapter, is promise to pay later. So account receivable is nothing but a promise your customer is making to you that they will pay you at a later date. And then you receive the cash, and then you use the cash to do all of those things again. So this cycle continues until as long as you are in the business. Operating cycle of a service firm. There are two primary types for service firm. One is perform a service and account receivable but no inventory. So remember, service firm has no inventory. Merchandising firm has inventory. Therefore, they do not have what we call, therefore they don't have cost of goods sold. So service firm has no inventory and therefore has no cost of goods sold. Account receivable, not inventory. Payment from the customer. So here is the cash. You perform the service to the customer. They promise to pay you later. You receive the cash and then you perform the service. Over here, it is important that you receive the cash so you can make payments. But here you are providing a service. So the most of the cash is going towards your operating expense. Over here, your cash is going for both operating expenses and purchasing the inventory. Merchandising inventory works in two systems. One is perpetual and the other is periodic. So we are going to talk about here mostly perpetual. So business needs to determine the value of merchandise inventory on hand and the value sold. So that's the job of a business. An accountant cannot tell you, but it's a job of business how they want to do it. Whether they want to use the perpetual inventory or whether they want to use the periodic inventory, it's totally a decision made by the business. Some business, a lot of the business that you're going to interact as an accountant, you will notice they are using the perpetual inventory and they are also using the periodic inventory. So the word periodic inventory comes from the word period. What it means that either every month or every quarter or every year, we are going to measure or count our inventory. In a perpetual system, you count the inventory on every transaction. For example, you go to Walmart and you notice there are 5 bottles of shampoo. As soon as you pick the bottle of shampoo and put it in your cart, and once it's checked out at the checkout corner, the system automatically updates that we have sold another bottle of shampoo and we have left with 4. So there is something you're going to learn in the in accounting 2302 manager, say point of sale and also sale order, the point at which you are going to make an order. So it could be at 4 or it could be at 40, that okay, I left with 40 units or I left with 4 bottles of shampoo, I need to order more bottles of shampoo. So that's another reason of keeping track in a perpetual way. The two accounting inventory system we talked about, periodic and perpetual. A periodic inventory system requires a physical count of inventory to determine inventory on hand. All right. And the perpetual keeps a running computerized record of merchandise inventory. That's something that I have just explained. However, the companies who use perpetual inventory system also most of the time use periodic inventory system as well. And the periodic inventory and perpetual inventory system is something of a question that you may encounter in your interview, even as a business major, not necessarily as and especially those who are interested in management positions. This kind of questions pop up in your interview. Purchase of merchandise inventory recording in a perpetual system. So how do you do that? The cycle of a merchandise began with the purchase of merchandise inventory. So the first point is when you purchase the inventory. Imagine you are opening a store and you are going to sell cake. What are you going to do? Your bakers are going to produce all kinds of cake that you want to sell, and then you will arrange those cakes in a showcase before you open the door of your bakery on the very first day of the business, because you want to make sure that people are able to see your inventory. So therefore the purchase of merchandise and inventory, and for you as a baker the bakery items to display on the store is the first way of making sure that you will get the attention of the customer. An invoice is the seller's request for payment from the purchaser. So a purchaser usually have a purchase order, and an invoice, they send the purchase order to the vendor, and the vendor send them the invoice after delivering the merchandise that says, okay, you owe us this much money and we would like you to pay. So invoices are also called bills. Sellers have sales invoices and purchaser have purchase invoices. So if you are purchasing, you will have a purchase invoice with the purchase order, so you can see what you have ordered and what you have received, so you can talk to your seller if there is any item missing, and the seller will send you their selling invoice as well. So now we are talking about a discount. Why we are talking about a discount? Because you know that as a purchaser yourself, you like to buy things when they are on sale, when they are offering a discount. For example, you want to buy a nice jacket and you find out that some company is selling jackets for 50% off. So you definitely want to go and check out those jackets, because at $200 you may not be able to afford that jacket, but at $100 it's in your buying range. So you are interested to know what you can get for $100. So that's the same discounts the purchaser receives from the vendor. That, for example, Best Buy is buying 10,000 iPhones. As you know, in retail, the iPhone is about right now, what, 1,500, for example, but they will get at a deep discount because they are purchasing 10,000 at the same time. So a purchase discount is a discount that business offer to purchaser as an incentive for early payment. So because when you give them a deep discount, you also want to give them a discount where you want to say that we'll give you this discount, and besides that discount, we also give you a discount if you pay us early. Credit terms, make sure you know this, are the payments terms for the purchase or sale, and these are the example here. So 3, 15, and 30. It simply means saying if you pay me within 15 days, whatever the total amount of the invoice, I will give you additional 3% discounts. If you didn't pay me in 15 days, then you must pay the whole amount, and stands for whole amount, for within 30 days. So N is equal to whole amount of an invoice. Okay. What is purchase return and allowances? The invoice price for a purchaser may need to be adjusted for purchase returns or purchase allowances. Purchase returns is very simple, that if you find any item which is defective, broken, or not looking great, you can return it for the full amount. Or the purchase allowances. Now we're going to see what is a purchase allowance. Purchase return exists when seller allow purchaser return merchandise that is defective, damaged, or otherwise unsuitable. Purchase allowances are amounts granted to purchase an incentive to keep goods that are not as ordered. Let me give you an example. I am placing an order for 100 chairs, and I specifically says that I would like you to send me 100 blue chairs, but the vendor has only 50 blue chairs. So he sent me 50 blue chairs, and instead of the next 50 chairs, he sent me, say, red chairs, 50 red chairs. So now I am sitting with 50 blue chairs, which is acceptable for me, but the 50 red chairs, which is not acceptable. So the vendor would give you additional allowance and say, I will give you 10% more discount if you keep those red chairs. Okay, so that will be a purchase discounts, and then the purchase return and allowances. The transportation cost. Purchase agreements specify shipping terms to determine with the title of goods transferred to the purchaser and who pays the freight. So it is, again, it is not accounting decision. It is a decision that is made by a purchaser and seller. So they make a decision who is going to pay for the freight. Basically, freight simply means for shipping charges. And at what point the ownership of the shipped items will be changed hands, and at what point. So there are two terms that in business that we use. One is called FOB shipping point and FOB destination. FOB shipping point simply means as soon as the vendor ships the item, means give it to UPS or FedEx, he has no responsibility, means the ownership transfer to the purchaser. Okay. FOB destination simply means that once the vendor gives the product to UPS or FedEx and they take it, once they reach to the destination, then the ownership will be transferred once the UPS and FedEx handed over to the purchaser the merchandise. Okay. So again, it says buyer takes ownership to the goods after the goods leave the seller's place of business. In the FOB destination, buyer takes a responsibility to the good at the delivery or destination point. Delivery and destination is the same thing, is because it could be your warehouse or it could be your retail shop. So in this case, the seller owner of the goods while in transit. So the ownership stays in FOB destination to the seller while they are in transit. Over here in FOB shipping point, as soon as the seller gives the purchaser, the seller gives the UPS and FedEx that ownership transfer to the purchaser. So that's, you have to keep in mind the distinction between FOB shipping point and FOB destination, because there will be questions that you need to solve in your homework, quizzes and exam that will require you to know the understanding of FOB shipping and FOB destination. Okay. When merchandise are required to pay for shipping, so there are two costs, freight in and freight out. You need to know this also. This is freight in is a transportation cost to the shipped goods into the purchaser warehouse. So who is going to pay to the FedEx or UPS to bring those things? Freight out is the transportation to ship goods out of the seller's warehouse and to the customer. Thus, it is a freight on the goods of sold. So freight in is part of cost of inventory. So it's a freight in is part of cost of inventory. And freight out is the part of cost of sale. For example, let me give you an example. Amazon is purchasing 10,000 cell phones from Apple. They will discuss who is going to pay for the cost of the shipping. If Amazon is paying for the cost of shipping, that will be included in the cost of inventory. So for example, 10,000 iPhones cost $10,000 and the shipment cost was $1,000. So the cost of inventory is not anymore $10,000, it is $11,000, and we'll show you a formula a little bit later. And part of the cost of sale, for example, Amazon is selling you a Apple phone, but you are an Amazon subscriber, which you pay like $100+ every year. So they are not going to charge you shipping. So that shipping becomes their cost of sale. So they will add that it cost us to ship say $20 to Brian, and that's why you are not paying, but Amazon is paying that cost. Okay. Freight in within discount period. Under FOB shipping point, the seller sometimes prepays the transportation cost as a convenient and lists the cost on the invoices. That's all it. Cost of inventory purchase. That is very important to know because we're going to talk about cost of inventory, how's it calculating. So the net cost of inventory allows a business to determine the actual cost of merchandise purchase. So let's see what is the formula. It's net cost of inventory purchase is equal to purchase cost of inventory. Suppose we are purchasing $10,000 of material. And then we have purchase returns and allowances. So we have a purchase return, say for $1,000, and they're giving us a $500 invoice, an allowance to keep it. And then we have a 3% or say $300 discount. And then we pay $500 for freight in. So what is the answer here? It's $10,000 minus the $1,000 minus $500 minus $300 plus $500. So what is my net cost of inventory? 10,000 minus 1,000, 9,000. 9,000 minus 500, 8,500. 8,500 minus 300 is equal to 8,200 plus 500 is 8,700. So with all of those things, that something that I have purchased for $10,000 is actually costing $8,700. What is the cost? And this formula is extremely important. Make sure you know this formula, because, or you write down in your notes, because you will have to solve questions, your homework, quizzes, and exam based on this formula. Cash flow. A company begins the year with a certain amount of inventory. It's called beginning inventory. So remember, we talked about in the previous 4 chapter, inventory is an asset. Asset belongs to balance sheet. And the reason they belongs to balance sheet because they are permanent accounts, and permanent accounts has a beginning balance and ending balance, and their ending balance at the end of the year or month or quarter becomes the beginning balance on the next month or the next quarter or next year. So that's why. So we start with added this are additional cost of goods purchased. So we purchase another cost of goods. Together they make up cost of goods available for sale. And from this amount, some of the inventory is sold, which is called cost of goods sold. The remaining makes ending inventory. Let me show you in a T account. So here is your inventory. Here is your debit. Here is your credit. So this is your beginning inventory plus purchase. That is your purchasing inventory. That is equal to goods available for sale. I'm writing in short form. And then you sold some of those things, which become cost of goods sold, right? And this supposedly begins with ending inventory. So that's how it works. Beginning inventory plus purchase equals to goods available for sale minus cost of goods sold is equal to ending inventory. And if you want to write down, you can say ending inventory is equal to beginning inventory plus purchases minus cost of goods sold is equal to ending inventory. So you can do that way as well. Ending inventory is equal to beginning inventory plus purchases. That's a plus here. And or you can say plus and minus the cost of goods sold is equal to your ending inventory. Okay. Then we have a recording of merchandise inventory in a perpetual inventory. So how do we record it? Because basically using debits and credit operators. So by doing it by using debit and credit operators and recording in a journal. The amount of business earns from selling merchandise is called sales revenue. We have already talked about. 2 entries are required to record sales transactions. The first entry records sales revenue and cash or account receivable. The second entry record cost of goods sold and merchandise inventory. So let me show you over here. Debit, the first one, cash or account receivable, and we're going to credit sales revenue. In the second one, we're also going to say debit cost of goods sold, and we're going to credit inventory. What we are saying, our inventory is going down and our cost of goods sold is going up. Here we're saying either our cash or account receivable is going up, and as well as our sales of revenue is going up. Or we can say that our sales revenue is going up because we just made a sale. Either we got cash or a promise for the cash at a later date. Or here we are saying our inventory is going down because we sold it and now it's cost of goods sold. Okay. So that was part from the purchase. Now it's the sales. Sales discounts, many sellers offer customer a discount for early payment. Okay. Sales discounts are a reduction in the amount of revenue earned on sales for early payment. The new revenue recognition standard requires sales to be recorded the net amount or the amount of the sales less any sales discount. Okay, and we're going to talk about a formula here in a minute as well, just the opposite of purchase. Sales return and allowances, the return of goods by a customer or the granting of allowance is called sales returns and allowances. Just the opposite of what we have studied in purchase returns and purchase allowances. Estimating sales revenue, under new revenue recognition, companies should only record sales revenue in the amount they expect to eventually realize. We're going to talk about a little bit more. Basically what we are saying that we should recognize what we expect to receive from our customer. Companies must decrease sales revenue by an estimated amount of sales returns. Means you know that as a customer you have a right to return your whatever you purchase. So a company must recognize what percentage of items or products will be returned, and for that we use historical data can be used for this estimate. You can make a ballpark figure, say it's going to be 5%, or if you have been in the business for a few years, you can see what percentage of things people are bringing for you to return it. Adjust and close the accounts of merchandise businesses. Actual inventory on hand may differ from the what book shows. Okay, so what we are saying that when we're using a perpetual account inventory system and we're recording every single transaction, we'd say we have 50 of these items left. When we go to the warehouse and we count these items, we find 44 44 merchandise left for a particular item. So there is a difference of 6. The computer showing you have 50 items. The warehouse counting shows you have 44. So what happened to the 6? So the 6 is part of what we call inventory shrinkage. It's basically a loss of inventory from theft, damage, or errors. Errors could be in the counting or errors could be in the computer. Damage means somebody mishandled it. Theft, it means it's not there. Somebody has stolen it. Businesses take a physical count of inventory at least once a year. Majority of the companies that have their assets tied up with this inventory, they sometimes do 4 times or 2 times a year to want to make sure how much inventory, because inventory can be damaged, inventory can be stolen, inventory could be expired. So all of those things, in order to keep in mind, we have to check the inventory, even though what we are doing using perpetual inventory, and perpetual inventory theoretically there is no physical count, and the physical count comes from the periodic inventory. So the merchandise inventory, even though the businesses are using perpetual, they still use the physical count, which is part of the periodic account inventory. And remember, the periodic inventory is from we begin, and the perpetual inventory we recognize once we start using computers. Okay, the 4-step closing process for merchandising company follows. Make the revenue accounts equal to 0, just like we have learned in chapter number 4 using the income summary account. Make expense accounts equal 0 using the income summary account. This is the 2 steps that we have learned in chapter number 4. And make the income summary account equal to 0 via retained earning account. This is again one thing that we did in chapter number 4. The closing entry then transfer net income or net loss to retained earning, net income or net loss, and make the dividend equal to 0 via retained earnings. So what we say that we have a retained earning account and we have a beginning balance, then either we have a net income or net loss, and we have dividend, and so this is a plus, this is a plus, this is a minus, this is a minus. Either we're going to have a net income or net loss, and that gives us the ending balance. And when we have a revenue or expense account, you know, for example, we have $200 in revenue and we have $100 in expense. Here is my income summary account. So this $200 will go over here and this becomes 0, and the $100 will go over here, this becomes 0, and we know that we have $100 of income summary, and this will become 0 when we put this $100 over here. And what we are doing over here is we're doing these things using debits and credit. So for example, we're going to say debit revenue and credit income summary, and we're going to do debit income summary and credit expenses. And over here we're going to do the third one by saying this debit income summary and credit retained earnings. So that's how we put 1, 2, and 3 of these things over here in this way. Well, merchandising company financial statement, it could be a single step statement or it could be a multi-step. Is definitely depending on the size of the business. Small businesses will use single step income statement and the large business will use multi-step statement. So in a multi-step income statement, operating expenses are reported in 2 categories. Selling expenses are related to marketing and selling the company's goods and services. Administrative expenses include expenses not included in marketing of the company. So for example, selling expenses include marketing and selling. The administrative expense would include like a head office, which has a CEO and their staff, their payment, their utilities, their rent, and things like that. And the gross profit minus the operating expense equals operating system. So for example, we have learned sales revenue minus cost of goods sold is equal to gross profit, and the gross profit minus this operating expense will give you operating income. Okay. In a multi-step income statement, other income and expenses report revenues or expenses that are outside the normal day-to-day operations, such as gains or losses on the sale, income tax expense, and other information. Again, the statement of retained earning and the balance sheet are similar, whether you are a merchandiser or a service business, and the balance sheet of merchandise is very similar except for 2 new asset accounts: merchandise inventory and estimated inventory. So the service company will not have these 2, but a merchandising company will have. Recording of multiple performance obligation in a perpetual. So what is a multiple of companies are required to identify performance obligation associated with each contract. What is a contract? Contract is a commitment that 2 parties created either verbally or orally, that they are going to do something for each other. For example, I am going to sell you a laptop and you are going to give me $500. So performance obligation, my performance obligation is to give you the computer, and your performance obligation is to give me the $500. Is a contractual promise. The performance obligation is a contract with a customer to transfer a distinct good or service. When contracts involve multiple performance obligations, the company is required to allow the transaction price to each performance obligation separately. For example, you ask me to not only give you a computer, but install Adobe software, the entire suite of Adobe, entire suite of Microsoft Office, and you also want me to wrap in a gift wrap, and you also want me to mail it using UPS to your door. So I will have to assign the cost of computer, the cost of the software, the cost of wrapping, and the cost of shipping. So once you do that, so I have to assign the cost for, so I will say the cost of computer is $500, cost of software $200, cost of packaging $50, and so cost of packaging $25, and cost of shipping $50. So my total cost of this is 5 plus 200 plus 775. So it's not only the $500 computer I'm selling, but I'm selling the computer with all the things that you have requested. Recording of merchandise inventory in a perpetual inventory. Perpetual inventory are too expensive for a smaller business, so mostly large business such as Walmart use it, Target use it. Periodic inventory require physical count of inventory to determine quantities on hand. Like I said, all businesses must do it. Merchandise inventory is updated at the end of the period during the closing process. So what we are saying that theoretically speaking, perpetual inventory system updates the inventory at every transaction, but the periodic inventory system only update the inventory at the end of the period, which is either month, quarter, or a year. Recording purchase, returns, and allowances. During the period, the business records the cost of all inventory brought in the purchases account. The balance of purchase is a gross amount because it does not include subtraction for discount, returns, and allowances. Net purchase is the remainder after subtracting the contra accounts from the purchases, which we have talked about. Purchases minus purchase returns minus purchase discounts is equal to net purchases. So we have to keep track of how many returns and allowances we are getting and how much purchase discounts, because it's important to calculate the net purchases and then necessary to calculate the cost of goods sold. Sale of merchandise inventory. No running record of merchandise inventory is maintained. There is no need to record an entry of and cost of goods sold. And accounting for sales discounts, sale allowance is the same as under the perpetual system. So basically what you are saying that when you are selling, they are not keeping track of any running record of merchandise in the periodic accounting. Preparing for financial statements. The periodic inventory system requires an additional calculation. The cost of goods sold. At the end of each period, the company combines the numbers of account to compute cost of goods sold for the period, and the calculation is shown in the income statement. So basically what you do, instead of calculating separately, you calculate over there with using purchases, returns and allowances, purchase discounts, purchases and freight in. You calculate using these things for your closing entries. So what are the 4-step process, the closing the periodic inventory system? We have already discussed perpetual, this time it's periodic. Using the periodic inventory system, sales revenue and sales discounts forfeited are closed with a debit via income summary account. All other temporary account with credit balance are also closed. The ending merchandise inventory and estimated return inventory are recorded as debits. Adjusting and closing entries and the 4-step closing process under periodic inventory system will be the same. Second, expense accounts and other temporary accounts with debit balance are closed via income summary account, exactly the way we showed you in the perpetual. The beginning merchandise inventory, purchases, freight in are also closed via income summary account, adjusting and closing entries. The 4-step closing process under periodic inventory system is the same. These steps are closing income summary, dividend accounts under perpetual and the periodic method are same. Okay. We're going to talk about sales discount, but we're also going to discuss this in the next couple of chapters. Many sellers offer customer a discount for early payment, and sales discounts are a reduction in the amount of revenue earned on the sale for early payment. New revenue recognition rules allow 2 options for recording sales discount. This is the important part. One is the gross method and the other is the net method. Record all sales at the full amount and record any sales count taken at the time of payment. Net method, record all sales at the time of the sale and record adjustment at the time of payment for discounts not taken. So we're going to talk about both methods in the next couple of chapters. We're going to show you the gross method as well as the net method. Please, thank you very much for watching these videos. If you have any question regarding these videos, please let me know. And if you want me to make any changes to these videos, please also let me know. And if you want me to change anything, also let me know anything. Again, thank you very much for watching this video. I hope to see you in the next video. Thank you.